Hey guys, welcome to Market Chart Watch. Today we're going to be looking at something that you might look into for retirement. So this is going to be a fund, an exchange traded fund, an ETF, a dividend paying ETF that you would typically have in a retirement fund. And this is going to be an ETF that pays you a dividend both now and into retirement if things stay the way they have historically. So what we're going to look at is SCHD, Schwab's U.S. Dividend Equity ETF fund, one of the best dividend funds, in my opinion, in existence. We're going to look at what Schwab has to offer within that fund. We're going to look at the prospectus document both through here and through Morningstar. We're also going to look at historical pricing and historical dividend yield. And then we're going to calculate that, and we're going to show you a nice graph of what those dividend payouts would be in retirement for you. So stick around. This is a super important video for anyone who's not currently in retirement. So say you're like me and you still have a 20 to 30 year time horizon and you want to start investing in your future. Well, a dividend ETF is going to be a great way to do that, to help diversify your portfolio outside of just an S&P 500 index fund or a small cap value fund. So I'm just going to walk you through some of the reasons why this would be a fantastic fund, and then we'll go through some of the numbers and what they mean. So number one, SCHD is very popular because it only holds large and high quality U.S. companies that both have a history of consistently paying out dividends. Typically, those dividends of those companies that it owns have been paid out for over 10 years. So that means that these companies are all typically financially healthy and they're very high quality. This fund itself is also well known because it pays a solid dividend yield on the 12-month yield and the secular yield. Okay, so that's always going to be very attractive for those of us who are in it for long term. This fund focuses on dividend growth, so it doesn't just chase high yield stocks like other ETFs, like JEPI, and there's others. So this is, again, a long-term hold. And then this fund is actually really great because it has a very low expense ratio for what it does. And it does that through being passively managed as one reason, and we can get into that later as well. As far as this fund's diversification, it holds just about 100 different companies. And although that doesn't seem like a lot, when I show you its portfolio balance, I'm going to show you why only holding 100 companies in this example is actually really great. And then as far as the historical value of this company, it has very strong long-term performance. So what I like about it is that it's simple and passive. You kind of set it and forget it. And then in retirement, you get paid a quarterly payout, sort of like having a pension fund. And you can use that throughout the rest of your life in retirement. So let's get into SCHD. So if we look at this, its current price right now is $25.30 per share, and it nets you a yield of about 3.74% on its most recent dividend payment. And what that means for you is that every share of this you own, you're going to be making a yield of about 3.74% on that every quarter. Annually, and that's going to be split up into quarters. Okay. The expense ratio to own this is 0.6%, so it's very low. And then this fund is in a large value category, so we'll talk about that as well, what all this means. So you can head to Morningstar.com. This is a great website to look into all this. You can see where $10,000 will get you in 10 years based on previous track records, and it can show you all kinds of good information. But what I want to do is I just want to head over to the Schwab Asset Management website and actually take a look at what they have to say about their own ETF. So again, that has a very low expense ratio, 0.6%. We can look at the opening price today of $25.30. And there's a whole lot of numbers here we're going to look at in a second. All kinds of numbers here. Okay. One of the things I want to highlight here is that its performance since inception has been around 12.93% return on investment. So that is actually better than the S&P 500 in the last 10 years. And we'll talk about how it did that. Okay. That's not abnormal. and it makes sense why it did that. Okay, we'll come down here. This is stuff we're not going to really need in this category here, but there's tons of information here that you can look at. But I'm just going to show you sort of the important stuff. Okay, so one of the things I want to talk about here is the distributions. You can see that this fund distributes on a quarterly basis, which means they're paying you a paycheck to own it. Okay, that's why dividends are so attractive. That dividend is at the rate of 0.2488 cents per share. Okay, or sorry, 24 and a half cents per share if you want to look at it that way. And based on how many shares we own, that turns into dollars, thousands of dollars, hundreds of thousands of dollars. And we'll show you that on this graph here that I've created. So we'll take you to an easier to digest page that talks about this SCHD ETF and some of the important information that I want you to know about. So when we look at the total annual returns of SCHD, we'll see that on its down years, it's typically only down a few percent, okay? 3%, 5%, etc. But on its up years, you can see it's averaged 16%, 20%, 27%, 15%, 29%, 5%, 12%. So its up years have always traditionally been much better than its down years. And how are we able to do this? Well, that's because of the fund category that SCHD lives in and the types of companies that it buys. Now, typically, and some will disagree with this, but for the most part, if we look at history from 1929 to 2025, okay, so this broad spectrum of time horizon, we can see that owning anything in the value category, either small, mid, or large cap value, you will get a premium on your money for owning this risk asset, okay? And the reason for that is these companies are valuable, which means their price to earnings or their price to book is lower than they should be, and therefore they are quote unquote considered at a sale price, okay? So this would be something that's on sale and the value is very attractive, okay? And so that's why typically in up times, these values take off because these companies are priced at a premium or at a low premium to where investors actually want to own them. All right, so hard to explain, but basically anything small cap, mid cap, or large cap value, you're going to have an incentive premium here to own it just based on previous returns. Okay, so that's one of the big points that I want to point out. And that's why it also differentiates. It's great for your retirement fund because it's going to be something that differentiates your S&P 500 fund, which is typically large cap blend or large cap growth. It's going to be really in this area. And so owning this SCHD really helps you to tilt, so-called, into the value area. So again, we're going to come down and look at our distribution yield. This is our dividend payout of around 3.72% over the last year. And some other really important information is the price to earnings ratio. So being that this is a value company, okay, this is, like Berkshire Hathaway, they've made their billions of dollars investing in value companies. When we look at our price to earnings ratio, typically we really want something between 15 and 20 in today's world. Benjamin Graham from The Intelligent Investor, probably one of the smartest people ever to write about finance, said that they want something between 8 and 15, and that was back in the 1970s. So times have changed a little bit. We've updated that to a price to earnings of about 15 to 20, and you can see we're on the low side here of 16. So that's how much an investor is willing to pay per dollar of earnings that this fund makes, or all the companies within it makes. And then when we look at the price to book, we're looking at how much the investor is willing to pay as it's related to the underlying amount of money that all those companies in combination are worth. So we have a price to book ratio of about 3, which is a little higher than normal. And we would typically see this in value companies because these are typically large companies. Think of like the Coca-Colas of the world that they're not growing, but they are staples in their respective departments. And then our price to cash flow, this is sitting right between our 8 to 15 mark. So you can see pretty much everything here is sitting on the low side, which minus the price to book, which typically would make sense in a value category. Okay. And then also we'll come up here when we look at owning this fund for 10 years or greater. You can see that it's within the top 25% of funds ranked by the Morningstar category, and that's why it's going to get this 4-star rating here. Okay, so let's kind of look down here a little bit. You can see some of the owning, or some of the things it owns: ConocoPhillips, Chevron, Verizon, Coca-Cola. You can see PepsiCo, Cisco. So these are huge companies that have been around a long time, and they've been dividend payers for over a decade. Okay, and you can see the staples in which SCHD owns. So this is just sort of a breakdown of what this fund is and what that means to the shareholder. But let's look at actual numbers. Okay, so we're going to look at from 2015 to 2025. You can see our dividend payout has gone from, 8 cents a share, 10 cents, up to 12 to 13 to 14 to 15, 20, 22, 23, 24. But have you seen in a 10-year period, our dividend payout has increased? And as so has the stock price. So this is why our book value, our price to book, is so high. We're paying that small premium knowing that we're going to get it back in a dividend and then some. But what are we actually going to get back with this dividend payout? Okay, so we can actually do the math here. Say you own this dividend ETF and you put it in something like a Roth IRA. Okay, now we know a Roth IRA is going to be tax advantaged. We pay the tax up front, and then that money grows tax-free for the life that it is in that fund until 59 and a half years. You can pull everything out without taxes. Also keeping in mind, you can pull out your principal, the amount of money you put in, at any time without incurring a taxable event. So let's take a look here, and let's just say we're going to max out our Roth IRA to the tune of that $7,000 a year, and we're without any capital growth appreciation. We're going to times that by 30. So this is without any return on investment. Okay, just assuming that we only had this amount of money in there. You can see we'd have $210,000. If we divide that by the share price today of 25.30, you can see we'd own 8,300 shares. And if we multiply that by how much we would make per share, and the last payment was 0.248 per share, so we multiply that by 0.248, your quarterly paycheck would be $2,000 per quarter, basically $2,058, if that money did not appreciate at all. So this is if the money did not appreciate at all and you just happen to put in $210,000 all at once. Okay, but let's do some theoreticals here, and let's say towards retirement, most people will have between $1 and $5 million in retirement. Okay, the younger you start, the more that is. So we can take $1 million and we're going to divide that into the current share price, assuming we're retiring today. Okay, divided by 25.30. And you can see we would now own 39,525 or 526 shares. But how much would we make on a quarterly basis on that $1 million? Well, we have to divide this, multiply it by how much we'd make per share, which on the last quarterly payment was 24.8 cents per share. So our quarterly payment was $9,802 if we were retired today. I'm going to divide that by 3 to give us a monthly payment, which would be $3,267 per month. That, my friends, is a dividend payment of $39,209 per year. Now, why is this so important? Without taking a dime out of your investment, in retirement, you are paid $1,000 a year to own this fund. Most other retirement assets like an S&P 500 index fund, a small cap value fund, a target date fund, etc., you would have to every year decide how many percent you want to remove from your retirement to live on. And the golden rule is you use 4% a year until you're out of money, right? Every year you remove 4%. So let's think about this. $1 million times 4%. So every year we'd be living on about $40,000 from our retirement, okay? If it wasn't in a dividend fund. And I would have to pull this money out every year out of my retirement. So my retirement was now $960,000. It went from $1 million, now it's $960,000. With this dividend paying fund, it's worth $1 million. Okay, that's great. I get a $39,600 payment every year. Sorry. And at the end of the year, I still have $1 million in that account because I'm never taking a dollar out of this fund. The dividend is just paying me to own it. So it's like having a pension, like if you're a cop, firefighter, you work for the county, etc. This is why it's so beneficial. Another reason this is great is those dividends, you want to reinvest them until you're retired. So every quarter, when you make a couple $100 here, a couple $1,000 here, it's getting reinvested in this fund and growing that snowball exponentially. Okay? So those are some big things. Now let's take all this calculator data and let's put it into a graph and show you what your retirement would look like if you had $1 million, $1.5 million, $2 million, $3 million, $4 million, and $5 million. So we already did the $1 million investment, which most people will have in retirement if you have a 30-year time horizon and you invested a normal amount. Okay. Your annual payment is $39,000. Your quarterly payment is about $10,000. And that means your monthly estimate is around $3,200 in today's money. If you had $1.5 million, that's almost $60,000 annually. That's more than most financial advisors would even tell you to take out in retirement per year. That's a quarterly payment of $15,000, and you're living on $5,000 a month. That's really good. That's most county employees' pensions right there in today's money. Okay. If you have $2 million. Now you're getting almost an annual wage off of your dividend payment for the average U.S. employee. That's going to equate to like $20,000 a quarter, and if you divide that into monthly payments, that's $6,500 a month. That's pretty good. Now, most people who retire with a 30-year timeline, they invested in an S&P fund, small cap value, or a dividend ETF like this. They should probably rest somewhere in the median here between 1 and 5. That'll sit you around $2 to $3 million. Okay. And so if we look at that, that's almost $120,000 a year in dividend payments. This is tax-free growth, tax-free withdrawal in a Roth IRA, only putting $7,000 a year in. If we look at that quarterly payment, it's almost $30,000, and you're almost making $10,000 a month off just dividends. You are not pulling a dime out of your investments. So you can theoretically live on this for 50 years, 80 years, 100 years, as long as those companies are paying dividends. And their previous track record shows that they have never stopped. Okay? Now, let's say we're in the 4 and 5 million. This is if you invest hard, you're transferring more money in, or you're maxing your Roth IRA, and then you're investing into SCHD in like your 401k or a traditional brokerage. That's something that I would do. I want to put in more than $7,000 a year into this fund for myself. I'm not telling you to do the same. But if you're in that ballpark, you're making $150,000 to $200,000 a year in dividend payouts. That's $40,000 to $50,000 a quarter. That's $13,000 to $16,000 a month. If you are retired today, and I know many people who have $4+ million in retirement, they could be making this much per month without pulling a single dime out of their retirement and without incurring taxable events. Okay, so that is what I wanted to show you about dividend paying ETFs and why they are so incredible. Now, with all that being said, I am not a financial advisor. This is not financial advice. And this is also not the only thing that you should own. You are not owning a very diverse portfolio if you only own 100 companies. And as I said, the S&P 500 is another common one, and small cap value is another common one. So in future videos, we're going to talk about those and why those may be great things to own in your portfolio as well. Happy investing. Thanks for watching. Like, share, and subscribe, and we'll see you on the next video.